Welcome to our channel Supernova. Managing cash flow is a critical aspect of running a successful business. Cash flow refers to the inflow and outflow of money in your business. Proper management of cash flow ensures that you have enough money to pay for expenses, investments, and debt obligations. Here are some tips to manage cash flow in your business. Number 1. Create a cash flow forecast. Creating a cash flow forecast is an essential step in managing the financial health of your business. It involves estimating the cash inflows and outflows of your business over a specified period. Here are the steps to create a cash flow forecast. Determine the forecast period. Decide on the time frame for your cash flow forecast. It can be weekly, monthly, quarterly, or annually, depending on your business needs. List your expected cash inflows. Start by listing all the sources of cash inflows into your business. This can include sales revenue, interest income, investment income, and any other income sources. Estimate the cash inflow amounts. Estimate the amount of cash you expect to receive from each source during the forecast period. Be realistic and conservative in your estimates. List your expected cash outflows. Next, list all the expenses you expect to incur during the forecast period. This can include rent, salaries, inventory purchases, loan payments, and any other expenses. Estimate the cash outflow amounts. Estimate the amount of cash you expect to pay for each expense during the forecast period. Again, be realistic and conservative in your estimates. Calculate your net cash flow. Subtract your cash outflows from your cash inflows to determine your net cash flow for each period. If your net cash flow is negative, you will need to take corrective actions to improve your cash flow. Review and update your forecast. Regularly review and update your cash flow forecast to reflect changes in your business operations and market conditions. This will help you stay on top of your cash flow situation and make informed financial decisions. Number 2. Monitoring your cash flow regularly is essential for the financial health of your business. It involves regularly reviewing your financial statements, bank balances, and cash flow projections to ensure that you have enough cash on hand to cover your expenses and investments. Here are the steps to monitor your cash flow regularly. Set a regular review schedule. Establish a schedule for reviewing your cash flow, such as daily, weekly, or monthly, depending on the needs of your business. Review your financial statements. Review your income statement, balance sheet, and statement of cash flows to gain a better understanding of your cash flow situation. Look for trends and patterns in your revenue and expenses. Check your bank balances. Check your bank balances regularly to ensure that you have enough cash on hand to cover your expenses and investments. Monitor your cash inflows and outflows to ensure that they align with your projections. Review your cash flow projections. Compare your actual cash inflows and outflows to your cash flow projections to identify any discrepancies. Adjust your projections as needed to reflect changes in your business operations and market conditions. Identify potential cash flow problems. Look for potential cash flow problems, such as late payments from customers or unexpected expenses, and take corrective actions to address them. Make informed financial decisions. Use the information you gather from monitoring your cash flow to make informed financial decisions. For example, you may decide to delay a purchase or investment if your cash flow projections indicate that you may have a cash shortfall in the near future. By monitoring your cash flow regularly, you can stay on top of your business's financial health and take proactive steps to improve your cash flow situation. Number 3. Managing your receivables is an important part of managing your business's cash flow. It involves ensuring that your customers pay their bills on time and taking proactive steps to collect overdue payments. Here are some tips to manage your receivables. Establish clear payment terms. Establish clear payment terms for your customers, including the payment due date, late payment fees, and consequences for non-payment. Invoice promptly. Invoice your customers promptly to ensure that they are aware of their payment obligations. Include detailed information about the products or services provided, payment due date, and payment methods. Follow up on overdue payments. Follow up on overdue payments promptly to avoid cash flow problems. Send reminders via email, phone, or mail, and consider offering payment plans or incentives for early payment. Implement a late payment policy. Implement a late payment policy that outlines the consequences of late payment, such as late payment fees, interest charges, and legal action. Monitor your receivables. Monitor your receivables regularly to identify potential payment issues and take corrective actions. Use accounting software or other tools to track your receivables and identify any overdue payments. By managing your receivables effectively, you can improve your cash flow and ensure the financial health of your business. Number 4. Control your expenses. Controlling your expenses is an important part of managing your business's cash flow. It involves minimizing unnecessary expenses, finding ways to reduce costs, and making informed decisions about how to allocate your resources. Here are some tips to control your expenses. Create a budget. Create a budget that outlines your expected expenses and revenues for the coming period. Use this budget as a guide for making decisions about spending and investments. Prioritize your expenses. Prioritize your expenses based on their importance to your business operations. Focus on essential expenses, such as rent, salaries, and inventory, and consider reducing or eliminating non-essential expenses, such as marketing or travel. Negotiate with vendors. Negotiate with vendors to get better pricing or terms for your purchases. Consider buying in bulk or forming partnerships with other businesses to get better deals. Track your expenses. Track your expenses regularly to identify areas where you can reduce costs. Use accounting software or other tools to track your expenses and identify any unnecessary or redundant expenses. Encourage cost-saving behavior. Encourage your employees to adopt cost-saving behaviors, such as turning off lights and equipment when not in use, using energy-efficient products, and finding ways to streamline business operations. By controlling your expenses, you can improve your cash flow and increase your profitability. By following these tips, you can identify opportunities to reduce costs and make informed decisions about how to allocate your resources. Number 5. Plan for capital expenditures. Capital expenditures, CapEx, are expenditures that a company makes to acquire, upgrade, or maintain fixed assets, such as property, equipment, or vehicles. Planning for capital expenditures is important for managing your business's cash flow, as these expenses can be significant and may require additional funding. Here are some tips to plan for capital expenditures. Create a capital expenditure budget. Create a budget that outlines your expected capital expenditures for the coming period. This budget should include estimates for the cost of each asset, the expected lifespan of each asset, and the timing of each purchase. Prioritize your capital expenditures. Prioritize your capital expenditures based on their importance to your business operations. Consider the potential return on investment, ROI, of each asset and prioritize those with the highest ROI. Consider financing options. Consider financing options for your capital expenditures, such as loans, leases, or lines of credit. Research the pros and cons of each option and choose the one that best fits your business's needs and budget. Plan for maintenance and repairs. Plan for ongoing maintenance and repairs for your fixed assets to extend their useful life and avoid unexpected expenses. Include these costs in your capital expenditure budget and consider the impact of ongoing maintenance and repairs on your cash flow. Evaluate the impact on cash flow. Evaluate the impact of your capital expenditures on your cash flow. Consider the timing of each purchase and how it will affect your cash flow in the short and long term. By planning for capital expenditures, you can ensure that you have the resources you need to acquire, upgrade, or maintain fixed assets. By following these tips, you can make informed decisions about when and how to invest in fixed assets and manage your business's cash flow effectively. By maintaining a cash reserve, you can ensure that your business has the funds it needs to weather unexpected expenses or cash flow gaps. By following these tips, you can build and maintain a cash reserve effectively and ensure the financial stability of your business. Thank you for watching. Please like, share and subscribe to our channel. We will see you on next video.